Welcome to The Explainer. Today, we're diving into one of the absolute most fascinating financial stories of the quarter, CIBC's powerful Q3 2026 earnings report. I mean, the bank just delivered a complete blowout quarter, and the headlines are frankly practically glowing. But we're here today to solve a central mystery. Is CIBC actually becoming a fundamentally better long-term investment, or has the market already priced in all this improvement?
Okay, let's dive into this. CIBC just posted a massive 26% jump in adjusted earnings per share. In a single quarter, their adjusted profit reached a staggering 2.65 billion Canadian dollars. Think about that for a second. That means their earnings are actually growing way faster than their revenue, which was up a still respectable 15%. It's exactly the kind of flashy headline number that makes investors sit up, take notice, and immediately want to hit the buy button.
But, here is where we hit some real friction in our investigation. The stock isn't exactly a well-kept secret anymore. As of late August 2026, CIBC is trading right around $163.82. What you really need to take away from this is that the stock has climbed roughly 38% from its starting level earlier in the year. So the investing world hasn't just discovered this bank's turnaround, they've already aggressively rewarded it.
So let's get into Section 1, the earnings mystery. Are we looking at structural improvement, or is it just cyclical?
Notice the incredible tension here. We've got a 26% earnings rocket versus a 38% stock rally weighing it down. Have investors already paid for all the good news? It's kind of an uncomfortable question, isn't it? When a bank's earnings accelerate this quickly and the stock price outpaces even that fantastic growth, we can't just blindly pop the champagne. If you're looking to put your capital to work today, you have to figure out exactly how much of this incredible growth can actually last, and whether expectations are now simply set way too high.
Moving to Section 2, where is the growth? Let's break down the revenue.
To answer our central mystery, we need to gather some real evidence and break apart CIBC's $8.37 billion in quarterly revenue. When we look at where that growth actually came from, a fascinating picture emerges. You've got Canadian personal and business banking up a very solid 17%. That's their core domestic franchise showing serious momentum. The U.S. commercial and wealth division is up a strong 26%, proving their cross-border strategy is really gaining traction. But look at that third category. Capital markets jumped 34%, generating $722 million in net income. So while domestic and U.S. banking did incredibly well, capital markets clearly did a massive amount of the heavy lifting this quarter.
And well, that right there is the catch. We have to contrast structural improvement against favorable conditions. Core banking growth, things like lending, deposits, wealth management fees, that stuff is generally durable. You can usually rely on it. But that 34% surge in capital markets, that was driven by highly volatile equity trading and financing activity. It's absolutely fantastic for this specific quarter, but trading activity is notoriously sensitive to market conditions. It's cyclical. It can normalize just as fast as it surged.
Think of it kind of like a family business. Imagine your family business suddenly earns 26% more this year. That is definitely worth celebrating. But if you dig into the books and discover a huge chunk of that extra cash only came because the broader financial markets were just unusually wild and active for a few months, you wouldn't automatically assume you're going to get that exact same windfall next year, right? You'd have to ask yourself, what part of this sudden income jump is actually permanent, and what part was just a really lucky break?
Which brings us to Section 3, the hidden risks. Let's talk about the costs of banking growth.
Figuring out what is permanent means we have to look really closely at the costs, because as any good business owner knows, structural banking growth is never free. There are some hidden complications beneath those glowing headline numbers. First off, CIBC reported its provision for credit losses at $564 million, which is barely higher than last year. Sounds amazing, right? But that number was actually aided by a favorable provision reversal on performing loans, plus an allowance release associated with the sale of U.S. commercial real estate loans. Basically, the economic outlook shifted in their favor this time, which seriously helped the bottom line. Second, their expenses are climbing. CIBC is heavily investing in rising tech and AI workspaces. They're rolling out an enterprise-wide agentic AI workspace and a platform called Advisor Assist to cut down on admin work. They're also paying higher employee compensation. Now, those are great long-term moves for sure, but eventually those shiny new tech investments have got to prove their worth by actually boosting productivity and revenue.
Let's move to Section 4, bull versus bear case. Time to weigh the evidence.
We have all the evidence gathered, so let's see how this builds a definitive case on both sides. I absolutely love looking at a clear showdown like this. On the bull side, the profitability is genuinely impressive. CIBC's return on equity, or ROE, jumped from 14.2% a year ago up to 16.8%. Their capital position is rock solid with a CET1 ratio of 13.4%, meaning they have a massive safety cushion of top-tier capital. Plus, they're aggressively returning money to shareholders with a $1.07 quarterly dividend and authorization to repurchase up 30 million shares. But we've got to weigh that against the bears side. Those surging capital markets numbers, they could easily normalize. The broader economic credit cycle could turn, causing impaired loans to rise. And those climbing tech and compensation expenses might start eating into future margins if the bank needs continuously rising spending just to maintain its growth.
And this brilliantly illustrates the core dilemma investors are facing right now, which we can think of as the rental property analogy. Imagine you're looking at a fantastic rental property. The foundation is strong, the tenants are great, and the rent is actually growing. It's a wonderful asset. But suddenly, the seller is asking you to pay 38% more for it today than they were just a few months ago. The asset is still absolutely great, but your risk-reward profile completely changes when that entry price skyrockets.
Let's run a quick back-of-the-napkin calculation to show exactly what this valuation dilemma looks like. If you take Q3's adjusted EPS of $2.73 and simply annualize it, just multiply it by 4, you get roughly $10.92 per share. At a stock price of around $164, that equates to a multiple of roughly 15 times those annualized earnings. Now, I have to caution you here. Blindly extrapolating one perfect quarter into the future is incredibly dangerous. Why? Because that Q3 number includes highly market-sensitive wealth management and trading activity that won't necessarily repeat perfectly every single quarter. The market is definitely pricing in continued strong returns, not a struggling bank.
Finally, Section 5, the final verdict. Do we buy, watch, or pass?
So, we've weighed the growth, the hidden risks, and the valuation. It is time to render a decision purely on the evidence. Based on everything we've uncovered, my verdict for CIBC stock right now is watch and wait for a better price. Now, to be perfectly clear, this is not because CIBC is a bad bank. Actually, scratch that, it's quite the opposite. The business is genuinely fundamentally improving, and they are definitely no longer a turnaround story. But at these elevated prices, the market basically demands perfection. The next dollar of return depends on sustaining this new high bar. If you're going to pay a premium, you need to watch 3 things very closely over the next few quarters. First, watch the adjusted ROE. Can it stay elevated near that 16.8% level? Second, watch credit losses. Can they keep them controlled if the broader economy shifts? And third, watch those net interest margins to see if the core banking engine actually remains healthy.
So, what's next on the calendar? You'll absolutely want to mark these dates to see how this plays out. We're coming off that massive August Q3 beat, with the stock hovering around $164. Looking ahead, Q4 earnings drop on December 3rd, 2026, which will give us our first look at whether the momentum actually held. But the real catalyst to watch is December 9th, 2026, CIBC's Investor Day. Management is going to lay out their strategic priorities, their growth opportunities, and capital allocation plans. That day is going to be the ultimate test to see if today's explosive earnings growth represents a permanent new baseline or just a really strong moment in the cycle.
As we wrap up this explainer, I want to leave you with one final thought to ponder for your own portfolios. If a great bank is priced for perfection, is it still a great investment? Never forget the critical difference between a fundamentally good business and a good entry stock price. They aren't always the exact same thing at the exact same time. Keep learning, keep questioning, and I'll catch you in the next explainer.